In the February edition of IQ magazine, we looked at the role of derivatives markets in the transition to a green economy. In the latest edition, published earlier this month, we take a deeper look at a key issue associated with sustainable finance, the development of a voluntary market for the trading of carbon credits. A voluntary market would complement existing regulated markets, but if countries are to reach the target of a net zero carbon dioxide emissions by 2020, it's widely accepted that there needs to be a robust mechanism for pricing carbon. To explain why carbon trading is so important, I'm joined by ISDA's Global Head of Public Policy, Stephen Kennedy. Steve, thanks for joining me.
Thank you, Joel.
We're hearing a lot about carbon trading in the context of reducing emissions at the moment. What's the connection?
So let's understand what carbon credits are first. They're essentially certificates that represent a ton of carbon dioxide that's either prevented from being emitted into the atmosphere or that's removed through a carbon reduction project. Carbon credits are naturally in high demand as countries look to increase the pace of decarbonization. And being able to trade these credits will help to meet this high demand. There was a task force last year, the Task Force on Scaling Voluntary Carbon Markets, that was established last year. ISDA was part of it. It was done under the auspices of the IIF, and it's leading the global work in the voluntary carbon markets. And it estimates that the market needs to grow 15-fold by 2030 to meet the commitments that have been made in various jurisdictions around the world.
Now, we've talked before about the role that derivatives will play in managing the risk associated with the transition to net zero. What has ISDA been doing to support this?
We've been involved in a number of fronts around the world. Certainly, we're part of the public policy discussions that have been happening in various jurisdictions, most notably and for the longest period of time in the EU, but also that are beginning in the United States, the UK, and in other jurisdictions. Documentation, obviously, is a foundational issue for ISDA. And we're looking at, recognizing the need for a robust legal framework. We're working with members to develop documentation templates to support voluntary carbon trading. We're also looking at the capital implications of carbon trading. How is carbon trading treated in the Basel Capital Accords?
Now, you moderated a panel discussion on this topic at ISDA's virtual annual general meeting back in May with a group of senior policymakers. What emerged from that discussion?
I think there were a couple of key takeaways. One, ESG is on the agenda of every major jurisdiction around the world, without exception. Two, there's divergence on how the jurisdictions are going to approach ESG and GHG emissions issues. There is some consistency, though, around the need for disclosure about climate risk. And I also think that there is support for voluntary carbon markets and increasing recognition of the important role they could play.
Well, thanks very much, Steve. You can read more about this issue in the latest edition of IQ magazine. This edition also features an interview with SEC Commissioner Hester Peirce, who has strong views on the topic of ESG. IQ is free to download on the ISDA website at isda.org. Thank you.